This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high-yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASX-listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing. Karen, how are you going?
Oh, I'm great, Owen.
It's going to be a good chat today. We're going to be talking about why it's hard to start investing. There's a lot of data around this that shows that people do really struggle to invest, whether it's shares, ETFs, sometimes even property, so many different things, and at all ages. So we're going to kind of talk about that and how you can move past it. Now, you're a money coach, you're an investor, you're also the chair of our investment committee, speaker. You do so much. What's keeping you busy lately?
What's keeping me busy lately? A lot of corporate work, actually. So going into employee workplaces and doing financial education, which I think is a fantastic initiative of companies that are wanting to give their staff and their teams more financial literacy and education, a bit of support.
Yeah, great. Yeah. And you just do that online? I noticed that you published something on LinkedIn not too long ago. You do that online?
I do. Yeah, most of those are online because a lot of the companies have different sites and are national. So online
great.
Makes it easy.
Yeah, wonderful. Well, hopefully you can bring to life some examples for the listeners today and for viewers, because whenever we have you on, there's always like practical takeaways and actionable takeaways that people can follow. So if we do refer to anything, by the way, we will share those in the show notes. So the first question is, why is it so hard for people to start investing, even when they know it's important or something they should be doing? We talk about this all the time. We talk about this thing called investing, but people still struggle. So why is it so hard?
So, Owen, it's not a money or financial reason why people struggle. It's a psychology and mindset reason that what I've observed is what blocks people from actually start investing. So, and a lot of it comes down to when I work with clients, it's their lack of self-trust, or they doubt themselves. Right. That's the biggest thing that I see. So, and that might play out as I'm really scared that I'll make the wrong decision. And when we're talking about investing, Owen, the stakes are high because if we're losing money, so there's a lot of fear around that as well. So just that self-doubt, that self-trust. And then you've got other dynamics where everyone else has done it. I should have done it years ago. It's too late. Why bother? There's so much information out there. I wouldn't even know where to start. So it really does come down to the psychology rather than the actual money. Because a lot of people that I work with, they've got the money sitting there, and sometimes it just sits there for years. Yeah. And they know they need to do something.
Yeah, we had one woman who come to one of our events quite a few years ago, and she said she'd been digesting content, like listening, watching, reading, I think she said for about 20 years. And this was the most extreme example that I came across. And it wasn't until COVID that she finally was like, well, I just got to do it. There's nothing else to do. I'll just do it. And she started, and she listens to this podcast. And so she kind of took it all in, but she had all this information and just felt like paralyzed by it. When it comes to self-trust, what does that look like? Like, how does that kind of, like, if someone's feeling that, how do you know?
So, and if I could just explain what you've described with that person in your community, that is fear disguised as research.
Yeah, right.
There's a fear there. So we'll use it's not the right time, I don't have enough, all of those things. When you scratch under the surface, it's a fear.
Right.
So it's about identifying what is the fear that you have.
That's a really interesting way to look at it. Yeah, it makes sense. So they kind of might overload on research to try and compensate for that.
Correct.
Yeah, right.
Yeah,
okay.
Yeah, correct.
So when it comes to then like the self-trust, is that the trust element there? Is kind of fear, or is that something different?
Yeah, so it's that lack of self-trust is they don't believe in their ability to look at that research and make the right decision around it. So it's really, and so what I encourage people to do then is to look at other areas where you have made good decisions. And so you need to tell your brain that I actually can be trustworthy. I can make good decisions. I coached a client. She had tens and tens of thousands of dollars sitting in a bank account, and she wanted to buy a property. But I ran into her years later because she said to me, yeah, I really want to buy property and invest. And ran into her a couple of years later. And I said, how'd you go with your investment property? Oh, I haven't done anything. It's still sitting in cash. So she did some money coaching with me, and we went back and worked through and had a look at her money story. And her money story was that she's only made financial decisions when she's been with a partner. So when she's had a boyfriend and she's made decisions, she's had that confidence there. She's had that support there. And then we were going through all of her other stories, and when she was on her own, she made some probably not great financial decisions. And so this girl had been on her own for a couple of years, and so she was just sitting with that. So the strategy around what she was doing around not doing it makes perfect sense when you understand the thought and the belief. And her thought and belief was like, I can't make decisions on my own.
Interesting. Interesting. So then what do you do to overcome that?
Yeah, so then we looked at, well, what are other decisions? It may not be financial. It might be health decisions, career decisions. What are those decisions that you have made over the past couple of years that have worked out for you? And so it's just about changing your identity and your self-trust and keeping promises to yourself. So I find one of the biggest things is, if you've got a friend and they say, we're going to catch up, we're going to do this, and then they don't, and then they do that on an ongoing basis, would you actually trust that person?
No.
But we do this to ourselves. Oh, I'm going to eat more healthy tomorrow. I'm going to get up early and exercise. And then we don't do that. And then we do that week after week, month after month, year after year. Do you think we actually trust ourselves when we say we're going to do something and we do it? Yeah. We don't. Yeah. So we need to start keeping promises to ourselves. And that's where we kind of start as a baseline. So
it's kind of like the narrative that we tell ourselves. Yeah. I remember my old therapist used to say that the brain is very literal. And just that self-talk is so important, right? The motivation. I often find that I have this little card, Karen, that sits beside my bed, and it's got like different things on it, like reframing, perspective, gratitude, like all the things that you can tick off on your list every day. And I think it's not maybe until you have prompts like that, you can be like, oh, well, I'm actually retraining my brain one thing at a time, which is so helpful. Some of the things that I see as early stage barriers to investing, and this comes from, a lot of this comes from like ASX studies or investor studies across the world. It says, I don't know enough. These are the three big ones that I find. I don't know enough. I don't have enough money. And the third one is, I think the market's going to crash. So those are the three big ones that I always come across. And you're saying it's kind of self-trust. There's a lot of fear and that sort of a thing. Those are the ones that are most prominent with you and your clients? Yeah, that's right. So it starts there. That's the cause, but it shows up as those things that you just said. Right, okay, gotcha. That'll be the excuses. Yeah, right. Yeah. When you speak to people about this and you identify there's some sort of roadblock here, so you try and identify what is the emotion behind it, and then you go back and you try and find out like a money story, like an origin story. Is that correct? That's right. Yeah. So what is the thoughts that are keeping them stuck? What are those beliefs that they have? Yeah, right. So for that particular client was that I'm not capable of making good decisions on my own. We've all got our own beliefs around money and what stops us. Sometimes it might be that their parents lost money on the share market, or grandparents, or property. So they've just built this story or this financial narrative around that investing in this is too risky. So, but it's just about understanding what that is, because when you can understand what's actually going on psychologically, then the behaviour that you are doing, whether it's like avoidance or overload or overconfidence and investing and making poor mistakes, when you understand what the origin of the story is, the behaviour that you are doing makes perfect sense. Yeah. And then we can unravel it. Yeah, right. I remember when you did a presentation, it was at Ladies Finance Club. It reminded me of that saying, show me the boy at 7 and I'll give you the man. I often think about that, because then I remember that event very clearly with your slides and everything. It was wonderful. But I remember thinking about some of the prompts on the screen about like, where does my story begin? And I think it came from my parents. They split up and it was pretty harrowing as a youngster. Yeah. We didn't have a lot of money, so it was constant stress. constant stress. And I also had access to like my mum's bank accounts and that sort of stuff. So from a young age, I always saw that. And so I can see that later in life, how that's impacted me. One good example is my wife comes from a very stable kind of background, not like affluent, but like stable and really kind of sensible, I would say. And now the way we manage money is so different. Now, you do a lot of work with couples too, right? Do you see that as kind of a key point to bringing couples closer together?
Absolutely, yeah. So one of the key things that a relationship and couples need is financial intimacy.
Yeah.
And so it's really understanding where you're coming from. So the things that you do with money or don't do with money, understanding the reason why you do that, and if it's a challenge for you for the other person, how can we kind of resolve it or get on the same page with it, or just have some understanding as to what is actually going on beneath the surface?
So it's one that I wanted to talk to you about just quickly, because I know it's so important to people that I deal with, which is there's oftentimes one person in the relationship that is more money-minded and more investing-focused. So say if the one that was, like listening to this podcast or whatever, they wanted to get investing, but also wanted kind of the other one to buy in or at least be aware. Do they both do this task independently? Is that how you get that intimacy kind of beginning?
Yeah, so sometimes I work with both the couples.
Yeah.
And it's interesting, normally the person that comes to seek out the couples coaching is the one that actually has more of the challenges than the other person. But it takes a while for that to kind of, for them to see that, but that's okay. But then other times it is, I can identify that actually, your spouse is the one that's got some challenges. So let me work with him or her one-on-one. And then so they can kind of, because rather than just me telling them what their challenges are, it's much more powerful if they can unravel them and discover them and have those light bulb moments for themselves. It creates that lasting change.
Yeah.
So to be able to do that one-on-one is a lot more powerful.
So if my partner was saying something like shares are like gambling or something like that, which is a very cliche thing.
Absolutely. But I hear it all the time, Owen. I don't know about you.
Yeah, I do. Yeah. So where does that, where do you begin with that? You say, I go to my partner and she says, well, shares are like gambling. Is that then just asking the question why, or?
Yeah. So I never use the word why because it's very kind of it's not a nice word. It's very confronting. And as soon as you start with that, the person's already kind of on the back foot. Yeah. So can you tell me more about that?
Yeah. Okay.
Where did you first decide that investing's like gambling?
Yeah. Yeah.
It's like, I don't know. I was like, oh, just think about it for a minute.
Yeah.
Just go back, and when was the first time that you decided or that you observed or saw that investing is similar to gambling? Okay. Tell me more about that. So just be curious rather than judgmental.
Yeah. Okay. Yeah. Because it's interesting because that kind of narrative spreads like wildfire, because you have someone that loses money tells someone someone else then sees their shares or their ETFs go down. They lose, they might not even lost anything, but they're like, oh no, they're right. It is like gambling. It's not like a bank account. So it does seem very fear-based and emotive.
Yeah.
Once someone actually starts investing, how do you stay on the bandwagon, so to speak? How do you keep like your eyes fixed to the horizon, the long-term wealth that should come from investing? Like that's one of the things. Like we had Glenn James on the show late last year, and he said that getting started is the easy bit, staying invested is the harder bit.
Yep. Yeah, that's right. So I think it comes down to changing your narrative. So it was like you were saying earlier about the card that you've got all of those things that you need to tick off, and just as a mental reminder, we need the same thing with our money beliefs. So if we have always thought that it's risky, that it's gambling, we need to look for evidence that it's actually not. So if we can look at investors that have had good long-term results, we're having a look at market history and people not losing money over the long term, we need to build up that evidence in the brain, and it just takes that consistency. So just doing it on a daily, weekly basis is really, really important to keep top of mind, because our brain is hardwired. It's designed to avoid fear, to avoid fear and loss.
Yeah.
Okay. So the fear is coming up because it's trying to avoid you making a loss.
Yeah.
So we need to override that instinctive part of our brain that does want to keep us safe, because it's keeping us safe in the short term, isn't it? Because we're selling out and we feel safe. But in the long term, it's hurting us.
Yeah. It's interesting that you say you have to actively seek out the evidence, right? Because there's a continuous battle against the emotional wall and the news headlines and the clickbait stuff on YouTube, all the stuff that you might come across, trying to remain fixed on the horizon. I find that for me, maybe a strategy that might relate to people is when the stock market or any type of investing does fall, we always say, if in doubt, zoom out. So get perspective. I remember during COVID, the first thing I did, I spoke to investors that I really admire, and they said, well, what happened in the last crises and that sort of stuff, we just find companies that, if you're individual shares, I know you occasionally like individual shares as well, find companies that we know for sure will survive, because having cash rather than debt is a good thing for a company, much like it is for a person. And then it's but also let's zoom out and go back 100 years. How many of these types of things have we been through? Now, that was the first, I'm referencing COVID, that was the first, global pandemic that I could see in, I'm sure there've been others, but this one was really meaningful. But when I looked at the data, I was thinking, actually, in that time, we've been through 2 world wars, we've been through the Cold War, we've had a currency crisis, we've had the Australian dollar floating, all of these different things. And that actively finding that evidence gave me so much more confidence to then go and invest more. So I think is that a tangible way, a practical way that you can kind of see that in action? Yeah,
absolutely. And it's something that I share with clients as well, and any listener can do it, to zoom out. So just do a Google search, ASX 200 or a particular share, and it'll show you the daily share price. But if you zoom right out to the maximum, you can see the chart. So you can see all of those ups and downs, and the long-term trend is typically going upwards.
Yeah. It's like the Vanguard charts. I don't know.
That's right. Yeah.
They come out every quarter, and then there's the one online as well. There's actually this study, I don't know if you've ever come across it. I put it in the notes for today, which was one that Mitch brought to us, the Dalbar report.
Yes, yeah. So they've tracked 30 years of market data. So they've seen the 87 crash. They've seen the bull market in the 1990s, the tech crash. They've seen GFC, COVID. All of that data is in there because they've been doing that for nearly 30 years now. And what it's doing is it's tracking putting the money in the funds versus the investors. And they're having a look at, what's the difference between the investors and that behaviour part of it. Is it 2.8% or something like that?
Yeah, that's approximately what it is. Yeah,
something around that, a difference. And you think that's a big number, 2.8% difference per annum.
Yeah, so. It's huge. Yeah, and this is what, for people that don't understand the nuance here, so it'd be the difference between the return of the ETF or the investment that you've made and your actual return, because you get scared out at the bottom, or you buy in out of FOMO or greed at the top. Those are just some examples. You actually do worse than the fund. And we see this all the time with superannuation. People are always chopping and changing superannuation funds. So they see underperformance, or what they consider to be underperformance one year. It's only up 4% where the other ones are up 6%. So then they swap to the other ones, and then that one underperforms, and the other one that they left does better. And so we continuously see that. And that's I like this study, Karen, because it's the behavioural biases quantified. So we can definitively say what the monkey brain actually costs us with investing, and how hard that can be to stay the course. Hopefully nowadays, through more education and awareness, hopefully that kind of can improve.
And when you talk about superannuation, one of the things that I've seen way too many times as a financial advisor is that people will panic and they'll get their superannuation, and they won't change funds, but they'll switch it all from their investment into the cash option.
Yeah.
And then they sit in the cash. Some of them, Owen, forget that they've got it in the cash investment. And it just sits there for years.
Yeah, I can imagine.
And then they're kind of all panicky about, well, when's the right time to get back in? And we shouldn't be making that decision.
No. Yeah, Max, who used to write for us and do a lot of work with us here, he spent a bit of time during COVID at Q Super, and he said he remembered this story of a 26-year-old who called up, and they're not allowed to give financial advice because they're just not allowed to. It's kind of crazy when you think about it if you zoom out. But this 26-year-old said, I'm moving all to cash. And she was already in a conservative option, which is kind of crazy. But she moved it all to cash. And then as we know with COVID, it fell quickly, but then it rose faster than probably we've ever seen before. And she probably left 30% on the table by doing that. So just in the 1 to 2 years after.
Yeah.
So it was really, really sad. And hopefully that young lady is still... hopefully that young lady has moved out of the cash option into something more balanced at least, because her future will be eating away at her.
And it's a good reminder for any listeners that may have done the same thing.
Yes.
Go back and check.
Yeah, just check. Just log into your super fund. It doesn't take much time just to log in and just see which option you're in. Question number 5 for you is, what are the most common behavioural biases you see in investors? We could do as many or as little as you like, but just some of the biases that you and how you would characterize them.
So I think one of the first ones is that overconfidence. So I see people that have made a lot of money on crypto or they've picked like a mining share and done really well. And so then in their monkey mind, they're like, wow, actually, I've got some talent here as an investment picker or stock picker. And then they double down on that and they take more risks than they should, and it rarely goes well for them. Overconfidence.
I definitely had that when I was younger, starting out. I think a lot of people, I think we should say that like these biases are innate in us. They're not like something that you necessarily should feel shame about. They exist.
Yep, they're there. It's just the way that our brain is wired. But we need to remember that even sophisticated professional market analysts and portfolio managers, they don't always get it right.
Yeah, exactly. Yeah.
So why do we think we can?
Yeah, exactly. Yeah, exactly. So but Peter Lynch famously said, if you're good, you're right 6 times out of 10. So even the best people won't get it right every time. I see overconfidence as a real thing right now. Do you have any others?
There's a recency bias. So it's kind of like what you're talking about before when you want to zoom out. So what I see is a lot of people is whatever the market's doing at the moment, like that's the way it is. And I think they say, well, it's different this time. It's like, we know it's not different this time. And I think that is one thing that professional investors or the financial service industry do have over the typical investor, because we have had it drummed into us that history repeats itself. And so we can zoom out and we've got a lot better memory of those corrections and them coming back than a typical investor does. So it's that recency bias.
Yeah. I find that's happened. I don't know, I feel like when you say recency bias, right? Like as a bias that we might also come to, I feel like when most people think about that, they'll think like what's happened in the last year or something. Do you think that's fair?
Absolutely.
Yeah. But I feel like recency bias should apply not just for the last year. Like if you actually looked at the data, a lot of people, for example, think that investing in US technology companies, like big blue chips, is like a sure thing because they've gone up for the past 10 years. Yeah, I went back and did some digging recently. I can't remember the exact figures, but I think it was if you took from like the peak of the .com or just thereabouts, which was around the year 2000 for people that remember, you'll remember this clearly. And then if you took the US stock market, it would have taken you until 2007 to reach that point again. But it only stayed there for about 10 months because that was the top of the GFC. And then it fell until 2013. So I think I worked it out that in 13 years, you would have only stayed ahead for one of those 13 years. When you think about that, that's recency bias at both of those occasions would have told you, well, the stock market goes up. The stock market goes up. But it would have been like a thing that's reinforced over like 5 years worth of data. And so I think this comes back to a key point, which is diversification, Karen, which is
absolutely.
It can seem like a weight on your portfolio to have boring things like cash or bonds or other stuff. But it's during those other years where it really pays off.
Absolutely.
Yeah. Yep. So we've got recency bias, we've got overconfidence. You got any others for us?
There's one that's known as anchoring bias.
Okay.
And that's where we anchor our mind is focused on the price we paid for the share.
Yep.
So if we use it in a practical example, bought some shares, bought them for $20.
Yeah.
Did okay for a while, but then they've gone down to $10. And so our mind is anchored on, I just need to wait till they get back to $20 before I sell them.
Yeah.
But if you and I have a look at that stock and we're looking at the financials around that, rationally and logically, the environment that they were in, there's more competition or whatever the dynamics are, they're not going to be as profitable and they're not going to get back to that $20 again.
Yeah.
So it's time to get out.
Yeah.
But that bias will make us hold on to those shares.
Yeah. Yeah, I like it. Yeah. It's I must admit, like, anchoring is something that I see a lot of the times in cryptocurrency land, like not just Bitcoin, but all the cryptocurrencies. I think it actually comes from a lack of understanding of why things move the way they do.
Yes,
so,
correct.
Like you said, it's actually the company's performance which will inevitably dictate the share price performance.
Yep.
And because no one really knows why or how cryptocurrencies move, there's real no basis for that. So they anchor. It's very easy to anchor. Okay, so as we come to the end of this episode, what are some strategies people can use to protect themselves from biases or even from their own behaviour?
So one of the first ones is having an investment plan. So you've made the decision, you're going to invest, you've overcome all those fears, those blocks, those barriers, and I'm in. So create an investment plan, so a logical plan. And I think that's one thing that in the financial services industry we can do. So as financial advisors, we don't have an emotional or behavioural attachment to our recommendations. We just know the facts and the figures, and this is what you do or don't do. So before you get tied up in those biases or behaviours that are going to come out, have it written down and documented. This is my strategy. So that's number one. Number two, if where possible, automate things. So we're really lucky these days that we can set up regular investment plans of X amount per month. So rather than having to review and remake a decision every month, you can kind of do that for 12 months and just track it and do that. So,
I like it. Two really good things. So plan, and probably out of the plan, you probably think to myself, well, what can I automate? Of this plan, how much of it can I automate? Maybe through a platform, maybe through a calendar, something or other, maybe through something else more like at your bank with BPay or transfers or something like that. Yeah, imagine having to, I see this now both as a business owner, Karen, as you have done, and as an individual. As your life gets more complicated, particularly on the business side of things, there's no way the Rask business could survive without some automation. Like just thinking of like paying things or bills or whatever, you just got to have that much of that automated as you possibly can.
Yeah, I agree. When I was a financial advisor, young before children, I probably had like 20 or 30 shares in my portfolio and just, just monitor them all the time, really, really busy. And I just don't have that. I just need it more automated. So I use a lot more ETFs than I have in the past because that just suits.
Yeah, what you're up to.
Better. Yeah, that's right. And I think another thing is look at the figures. So do some tracking or reporting. Companies like ShareSite and can actually just give the data, have a look at the performance. I think those, there's lots of tools that we can use as investors to monitor and track those things.
That's what I was going to put in here as well, just to say, so you've got plan, automate, look at the figures. Yeah, tracking your portfolio with a performance tool. So a lot of people use ShareSite on Avexa for tax reporting, but they're also fantastic for performance reporting. So it tells you exactly how you've done, both from your income, your growth, all that sort of stuff. And yeah, you do have to pay a little bit for it, but you're better off figuring it out. Once I remember these tools started coming into existence, Karen, I remember thinking to myself, well, I better start tracking, because then if I'm not very good at this thing called investing, why the heck am I going to keep doing it? Why don't I just let the ETFs do it or someone else do it, like a professional do it for me? I'd add probably having a checklist. So even if it's just like a 3-point checklist or something like that, just whatever the case may be for people to use, because then you can use that to be like, oh, well, last time I did that and I had a bad outcome, so I'll update my checklist. I'll get better and I'll slowly improve my process. And the other thing would just be journaling. Much advice for life as it is for investing is just keeping record of what you're doing. And ideally, writing your thoughts down before you make a decision, I think is really, really important. It's definitely saved me more than once.
Yeah, absolutely. I think just writing down your thoughts, but also your emotions. What are you feeling at the moment? Because emotions don't make good financial decision-making tools. So just...
Yeah, that's true.
And you don't need to make a decision that day. Just, write it down and then look at it a couple of days later. And I think because it's not oscillating in our head and we've got it down on paper, there's this separation that happens and we can take more of a logical perspective by seeing it in writing rather than it just like buzzing around in our head.
I've got one more question for you to try and help people get started. But before that, how can people reach out to you, work with you, get in contact with you?
So if people are looking for more of that behavioural or they've got money beliefs or just don't like their financial identity, I think that's a really important thing too, is to understand your financial identity. People can find me at womentalkingfinance.com.au.
Women Talking Finance. I'm just putting that down. That's Karen's website. But you also do like corporate events and stuff like that.
Yes, I do.
Which could be good for groups and that sort of thing.
Correct, yeah. So if organisations are wanting to provide some financial literacy or financial education, or perhaps you want to reach out to your employer to ask, I have a website, Karen Eley, eley.com.au. Cool. And I've got examples of different talks that I do for companies.
I'll put them both in the show notes,
Thanks.
Karen. Last question. If someone's listening and they're sitting here on the sidelines, like the stock market's gone up, some people are predicting doom and gloom. Internally, I'm thinking, I know I should do this, listening to the podcast or other resources, but I haven't done anything yet. What would you do to encourage them to get started?
So start small. Like you don't have to invest all of your money straight away. So with clients that have got just money sitting there, they might have got an inheritance and they've added to that and it's just sitting in a cash account and they're just kind of frozen for all the reasons that we're already talking about. Well, you don't have to invest at all. Start with $500, start with $1,000, just start with a small amount, but then it is changing your identity that I am an investor, I've invested my money, and just watch it for a couple of months, for 6 months, or start a regular investment plan and just watch it. I think just starting is really, really important.
Like it. It's great. Well, Karen Eley, thank you for taking the time to join me on the show today.
Pleasure. Thanks, Owen, for having me.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.